Welcome to episode 2 of Advisor Wars, the podcast where we take a critical look at the key issues facing the financial advisor profession. I am Bob Huebscher, and co-hosting with me today is Joe Halpern, Managing Partner and Chief Investment Officer of Obsidian CIO. I am the founder of Advisor Perspectives and led it as its CEO until 2024, and it became the most widely read publication among financial advisors. Today is December 3rd, and our topic is interval funds, a structure that has grown rapidly to roughly $100 billion in assets under management. But a decade ago, that number was closer to $6 or $7 billion, and that means that interval funds have grown at an annualized rate of roughly 30 to 35% over the last 10 years. Much of that expansion has been driven by advisor and client demand for access to private credit and other alternative income-oriented strategies, and that is what we will dive into today. But before we do that, Joe, you just rebranded your firm to Obsidian CIO. What was behind that decision?
Yeah, thank you, Bob, and really excited to be speaking about interval funds today. So we just sold our partner firm, Fountainhead Advisors, to Lido. So real exciting exit and really proud of our journey with our sister company. We assisted in growing that firm from around $100 million to over $1 billion, all organically. So I have a lot of pride in that, and we believe we really contributed through institutional investing and really scaling through tech. Now, we're also excited for the next part of our journey, and we named it Obsidian CIO. Obsidian is a smooth, sharp lava glass that has been used historically for precision tooling. So it's a tool itself, and it helps create precision tooling, and what better a name than that for an outsourced chief investment office. We're creating precision tools. Those are institutional level investments for our RIA community, and we're scaling, so more precision tools within that tech. And the idea is really to empower our advisors to have the confidence and the luxury to be out there all day and using their craft. So precision built for RIAs, Obsidian CIO.
Well, congratulations on that exit and congratulations on the rebranding. There were a couple of pieces of research that were published within the last couple of weeks, one by Goldman Sachs, the other by JP Morgan, which I think tie into our topic today, and I know you're familiar with both pieces. Why don't you talk about them and how they relate to what we're going to discuss with interval funds?
Yes, definitely. And it highlights the attention on these non-liquid alts as defined in our episode 1 together. The article from JP Morgan by a fellow named Michael Sellenbast was an eyes on the market piece. It's a piece they put out once in a while, and it really discussed some risks within the alternative space. It recognized how much it's growing, how much it's being used, and then again, just highlighted areas of risk. So how do you figure out, as an example, within whether hedge funds really have alpha? Because the reason you're buying into a hedge fund is to have risk-adjusted alpha. Some concerns around private credit that's been going through the market. Some concerns, by the way, around private equity and venture cap, in that it's really been an elongated market in terms of these companies IPOing and going public, and also some relative underperformance, and then talks about what the market, the democratization looks like. Goldman Sachs produced a survey. They surveyed 1,000 high net worth, ultra high net worth clients, and they found that alternatives are being democratized. Probably the most interesting, something I thought about a lot, but one of the most interesting takeaways from them was that clients thought of alternatives as high risk, but are still really, especially ultra high net worth, 10 million and above, are really leaning on the products and allocating a lot to it. And I thought the high risk comment was interesting because you could actually, while there are characteristics that are risky, meaning that you don't have liquidity, you can't sell out in a day, the alternatives cover the spectrum of lower risk to higher risk products. So I just found it interesting. They're both great. We'll put them both in the liners, links to both of them. In our position as an OCIO, we look at all asset managers, so JP, Goldman, et cetera. Really, really interesting stuff.
Well, for listeners who may not be familiar with interval funds, can you explain how they're structured? In particular, talk about the use of predefined repurchase intervals, or what are called gates, that limit investor withdrawals and affect liquidity.
Definitely. So a mutual fund and an ETF are allowed to have 15% of their exposure be something that's illiquid and maybe a little bit hard to value. An interval fund can have 100% exposure. So when you think about what exposures are in there, they really have the capability, and to a large part do take advantage of this capability, to hold more illiquid securities that can't actually even be held in ETFs or mutual funds. So you're accessing really a new world. Now there's an exchange for that, right? And you mentioned it, Bob. You said gating, right? So what happens are these products, the clients are able to get in on a daily basis, but you can only get out generally on a quarterly basis. And when you do get out, the fund itself limits, they gate what percent of assets can leave the fund, and that gate is typically 5%. So there's an element of illiquidity in it, even though I think a lot of people perceive it as rather illiquid, but I think it's something people need to be careful about.
So I mentioned in my introduction that there's been a surge in the popularity of interval funds, and it's driven in part by the demand for access to private credit. Expand on that. What other significant trends are you seeing with respect to interval funds?
Yeah, so there's definitely, I think they're at the moment a darling of asset management and a darling of the RIA space. And it really comes down to simplicity. For the client, the simplicity is I could invest when I want, and this perceived belief that I could get out pretty close to when I want, within a quarter. It's not bad. It's very different than, say, a closed-end fund where you could get in and you have to keep on getting bothered for capital calls, and then you have to wait a very long time period to get out. And if you want to get out, historically, there's been a really large cost relative to the net asset value of that investment. So clients look at that and say, this is really nice. I could get in and out. Around tax time, they're also happy because it's 1099 tax reporting. It's very similar to ETFs and mutual funds. So that's very simple. Send it to your accountant. They don't bother you. It comes on time generally. So clients really like it. Advisors like that element of it. They also like the ability to really talk about an alternative investment. So alternatives are thought of as sophisticated, and I believe they are sophisticated. They provide, and we discussed this a little bit, they used properly, they provide diversification and opportunistic investing. So here, this advisor is going out and they're providing something that is perceived as simple to deal with by the client, with potentially a sexy narrative that matches their portfolio, and that provides a level of sophistication for the advisor. And then the one other element on the advisor side is that operationally it's much simpler than a lot of products. So operationally, you go in, you click, you buy a ticker, feels very normal. You only have to do it once. Exiting's operationally a little bit more difficult, but it pales in comparison to the difficulty of dealing with other sorts of products. And then finally, the asset managers love it. Why do the asset managers love it? These are great products to collect AUM. Bob, you mentioned it right in the opening. I mean, the growth here has been dramatic. And if you think about an asset manager in an alternative, in the alternative space, historically, they had to start new marketing and create new structures every couple of years if they were doing a closed-end or a vintage-based fund, and now it's evergreen. So you could just keep on going back over and over and over and over again with the same wrapper, same exposure, and say, you should buy this. They create track that's easier to track. So there's all these elements that look really, really good on the surface for interval funds.
Great. And I guess one other point is that they really align the goals of investors with those of asset managers. These are illiquid investments, and the asset managers don't want investors who are going to be trading in and out on a frequent basis. They want investors who have signed on with a long-term horizon. Interval funds carry a number of risks, and we're going to discuss those in a moment, but let's first look at the opportunity that they present in terms of access to illiquid asset classes. How do you frame that opportunity when you speak with clients?
Yeah, definitely. So it helps to categorize investors. You have regular investors and then accredited investors, and then you have qualified clients and then qualified purchasers. And I bring this up because that's a regulatory definition that I just provided. On the top of that spectrum, qualified purchasers, people use the term QP, have to have $5 million of liquid assets. And there's a large subset of alternative investments that are only accessible to that QP group and above, well, QP and above, I'll call it, right? So institutional investors like pensions, et cetera. And then when you get to your individuals, those individuals in the world or in America that have $5 million or more of liquid assets, not including real estate. And the space is getting democratized. It's going lower and lower towards mass affluent and high net worth, et cetera. And there's just not a lot of products that are offered for that grouping. Interval funds is something that, or a wrapper that can be used traditionally by AI, so those accredited investors, and also a lot of times by mass affluent, meaning you don't even need that accredited investor framework to enter it. And so what's happened with interval funds is that it's just much, much more accessible by mass affluent. And so it is beneficial in that way.
Well, let's talk about the risks. The first risk I want to talk about is that the interval fund managers have to maintain a meaningful cash or liquid asset buffer to meet the repurchase requests that we spoke about a few minutes ago. How do you assess the risk that this liquidity requirement creates, both in terms of performance drag and portfolio construction limitations?
Yep, and it's great. It's a great question, and it's exactly where advisors should be focusing their time when due diligencing these interval funds. That's really the key. From a regulatory standpoint, that there's that trade-off, right? We're trying to, or the government's trying to protect smaller clients from having their money locked up and then really needing it, right? So that's kind of the historical background to it. If you go in, let's use venture cap as an example. Historically, if you wanted to invest in a venture capital fund, it'd be a drawdown fund. So it's a closed-end fund that would have a life of, call it, 7 to 10 years, probably closer to 10 years, to be honest. You'd have to put money in over 2 to 3 years and then just wait a very long time before you get that money back. And now let's think about the manager side. That asset manager is going and sourcing investments that they want to make, going to the client and saying, okay, we now have these 6 investments that take up 20% of the capital of the fund, give us 20%. Then 3 months later, they say, give us another 20% until they come up to kind of using all their money. Now, in that instance, they don't have to worry about cash. They made investments. They've invested fully on behalf of the client. And now everybody has to wait. Now, the asset managers are doing all sorts of work during that time. They're managing, they're looking at it. But the reality is it's a waiting game. And you hope it works out. In interval funds, the client, instead of giving 20% at a time, is giving 100% of what they commit. Let's just use a round number, $100,000. Day one, they provide $100,000, and then the asset manager has to put that to work right away. If they don't put it to work right away, you have drag on performance. So thinking about that in venture cap, where it really takes a long time to do diligence, and how exactly do you match the flows in and out? It's quite complicated. The way to deal with it in venture cap, and venture cap's a great example here because it's an outlier of sorts, is that you have to have 20% of your cash available, because generally speaking, there's a really long-term horizon with a very, very illiquid underlying security. So just doing straight up math, if you need to hold 20% on the side, and venture cap's supposed to return 12% when totally concentrated, well, 12% times 20% is 2.4%. So now you're underperforming someone who has the capability to go into a vintage by 2.4%. It's material. It goes from 12 to 9.6. And then the question is, are you really getting that illiquidity alpha? Is it really worthwhile? So it creates a Pandora box of questions of, hey, does this make sense? Am I getting paid enough for the risk I'm taking on? And so it just touches the surface, but I'll kind of stop there because I think, Bob, we could probably speak about this all day, just that element of it.
Well, thank you. And I think that's a very good explanation of the performance issues that this creates. But beyond this cash buffer issue, how does the illiquidity of the underlying assets create risks for investors? And I'm thinking specifically about periods of poor performance or when repurchase requests exceed expectations.
That's a great one. You hit on another major risk, which is now a strategy is underperforming, and there's a capability for clients to get out. And this is where it comes into that seeming liquidity bucket, where a lot of times clients will see underperformance and say, "I'm done. I want to get out of here," and they go for the exits. Now, quarterly liquidity of 5%, as a reminder, that's 5% of assets in the strategy. If 10% of, let's just say every client has an equal amount in the strategy, and 10% of clients come to exit, each one of them are only going to get 50% of their money back. We've seen instances where clients only get like 20% of their money back. So you go in and you say, okay, I want to redeem $100,000. And then the manager says, well, here's $25,000 back. And it could take a year, 2 years to get all your money back. So that makes for a very unhappy client. And it becomes something that an advisor has to manage effectively to not actually lose that client. Now, if you kind of flip to the other side, to the asset manager, the first asset manager in that venture, and we'll just use venture cap the rest of the time because it's a great example. But instead of focusing on, okay, let me go and look at another bunch of names to maybe add to the portfolio, this asset manager has to use a lot of their time to manage cash flows and really decide what to do, because all of a sudden there's uneven flows generally. There's stress. They may need to sell a product. And if you think about it, you have this illiquid security and you have to go to market for it. And by the way, Wall Street knows we smell blood really, really easily. It's like sharks. So it's like, oh, those people need to sell that product. We're going to lower prices even more. So that could hit onto the NAV, which creates this terrible, terrible cycle that's kind of hard to work out of.
So it's obviously a difficult asset to manage, but given the constraints that you just discussed, how difficult really is it? How much effort goes into maintaining liquidity rather than what a manager should be doing, which is finding the best investment opportunities? And related to that, given the demand that this places on management skill, what are the typical fees that you see in interval funds, say, with the expense ratios on mutual funds?
Yeah, so it's definitely, and we're using an example of venture cap because I think it's an outlier. I do want to be clear, there are definitely exposures that can fit in the interval fund. And what we're highlighting is that the gating, that 5% gate, which makes a lot of sense. I'm not knocking it. It's just that it's really, really difficult to manage to, and people need to understand that. And so one element is making sure to match the security exposure to the characteristics of the wrapper. In this case, we're talking about interval funds. So does it really belong in an interval fund? And even when the strategy has elements of liquidity, sorry, not the strategy, but the underlying security, it's still going to be hard to manage when you have to manage those cash flows in and out. But obviously you need that element to it. You need to understand the element of what is this underlying security? Does the security really match? And so managers are spending a lot of time there in terms of managing it. They're also looking at it and saying, how can I reduce that cash drag? So as an example, let's now go to a credit product. We were talking about venture cap, but let's say someone has, I literally just came from a meeting with a manager that is managing a credit REIT in an interval fund. And if you think about a credit REIT, it was shorter duration credit, and it's a lower yield where you can use while you could do some whole loans, there's also a lot of liquidity within structures that hold a group of credit REIT exposure. So you could kind of walk down the liquidity construct. You could connect from just having straight cash to having treasury to having some sort of more liquid product to the semi-liquid product. And again, the exposure is going to be less concentrated than, let's say, a drawdown fund, but it's way better. You may not be able to access that kind of product in an ETF or a mutual fund. And so there's some sort of middle ground there. And then finally, Bob, you pulled up fees. This is a hard job. It's hard to manage. And so these fees are going to be higher than where ETFs and mutual funds are. Traditionally, 1.5% to 2% management fee. And then depending on the product, there may be a carry. And a carry is a performance-based fee where they may take 10 to 20% of upside performance on top of, usually after a hurdle, and there's usually a catch-up, and all these elements are things. It's just really important to understand some of that lingo and understanding how that plays. I'll say two items about fees. One, you want to look at strategies from a net standpoint. Once in a while, I see it, not too often anymore because people have caught on, but you want to look at net returns. You never want to look at gross returns. And then you really want to understand that fee structure in terms of, does it match what the manager's doing? At the end of the day, there's a lot of strategies that just they take a ton of work and they're very specialized. They're really specialized, and I for one would say I think it's justified to take a higher fee for a variety of reasons surrounding what the exposure is.
So you've spoken about private equity and venture capital, and now credit REITs as vehicles that are bundled into or packaged into this interval structure. How should advisors assess the fit for the underlying asset? How do you determine, for example, the performance drag that the cash position will create based on the underlying asset?
It's a great question. And I'll say from personal experience, we at Obsidian, we actually looked for quite a bit of time at interval funds that held PE and VC. And the goal there is, wouldn't it be great if you think about private equity and venture cap, it's a big subset of exposures out in the world, and it could provide diversification for our client base and potentially upside opportunity. And so wouldn't it be great to be able to provide exposure, an opportunity to have exposure to that for our mass affluent constituents. Spent a ton of time. I think we looked at every single interval fund available that had a PE and VC exposure, and we ended up recommending none of them. We just could not get comfortable with that cash drag. We plan to look back at it. And the reason we're going to look back at it was there's a thought that maybe these strategies need to be more mature. If you think about let's just take an institution, let's take a pension fund. If they decide today they want to get into venture cap or PE, they would start buying into these closed-end funds. And they would buy what's called a vintage. They'd buy the 2025 vintage. And the 2025 vintage will play out in 6 to 10 years. JP Morgan, that Michael Sellenbass piece, Eye on the Markets, talks about exactly this. Now, how do these vintages do? So it's a worthwhile, checkout. So you buy in 2025, and you start seeing the benefits, hopefully, of that investment 2031 through 2035. That's a long time to wait. But as you keep on doing it, all of a sudden you become mature. If every year this pension's putting $1 million in, year out, well, they've effectively just created an evergreen product. They've effectively just created an interval fund. Now, they don't have the liquidity, but at some point you think, now let's fast forward, you have vintages from 2025 through 2035, you've been consistent, you've been putting in money every single year, you start creating cash flows, right? So the idea is, hey, how will this look? How will some of these interval funds that started 3-4 years ago, because that's when most of them started, how will they get to some level of maturity? And we kind of already spoke about some of the risks there, which means, well, for a pension fund, it's really nice. They could easily put in $1 million a year in, year out. But now you're talking about a more democratized product with a lot of participants. And in year 3, if everybody decides they want their money back, well, then the fund has a really hard time buying the vintage. So they're trying all these really interesting ways. They're playing, or I should say not playing, playing's the wrong term. They're acquiring secondary products, which maybe we'll talk about one day, but let's just say there's all these kind of, I'll say, creative ways to try to diversify within the interval fund. And I'm curious to see if we could get comfortable with one of those products, because again, I think it's a great benefit if done properly for the client, but I think it really needs to be thought through and people really need to be careful in this space.
So one thing that an advisor could do is to invest directly in these vehicles, in the venture capital fund directly or through a tender offer fund or a business development company or even through some mutual fund structure. How do you assess the choice between using an interval fund versus investing directly?
Yeah, another great question, Bob. Ultimately, the interval fund is a wrapper. It's a structure. So there's all these regulatory structures out there, and they all have their own characteristics, and they're positioned for different groups within the market. So generally speaking, if you have a client who's a QP, that qualified purchaser has $5 million or more, I'd say generally you want to lean into products that are QP only because they're able to concentrate and really focus that exposure with less of that cash drag that we've spent a lot of time speaking to, which has all these benefits that accrue to that client. So that's an example. And I'll say bigger picture, just generally straight up answering the question is, these are all tools. And Wall Street has done an incredible job. I used to be in one of those seats of creating product. It's done incredible jobs of creating more and more product that provides access to the client. Now, it's a double-edged sword because on the other side, it means that there's a lot of complexity. What are all these structures? Just because we've created those structures, it doesn't mean that they're used appropriately. How is the manager using it? even if it's used appropriately, it doesn't mean that you're going to use it appropriately as an advisor. Meaning, like, how should I think about this exposure and what subset of clients should I use this strategy for, and where does it maybe not make sense? As we discussed before, Wall Street always smells blood. They'll know if something's going wrong and take advantage of it, and that will not be good for your clients, and it won't be good for advisors. So, great. It's another great product, and I understand why it's grown so much, but I do think that people need to be careful when thinking about it. I don't think it's one of those solves that works for everything.
You mentioned that being a QP, a qualified purchaser, is an important consideration in determining whether someone is better off in an interval fund versus the underlying structure. How else do you assess which clients are suitable for interval fund allocations, particularly regarding time horizon, their liquidity needs, and their income expectations?
Yeah, for sure. And this is another spot to just focus in and say, I think that this product has been so popular because of the simplicity element of it. This concept, or maybe it's even a false flag of pure liquidity, or it is a false flag of pure liquidity. There's an element of liquidity to it. The 1099 reporting. And so I think I believe that advisors are attracted to it. And I just want to highlight it does make sense to really look under the hood and really understand that exposure. And so now when you think about a client, if a client is a client where you may be concerned about their liquidity needs, I'd say don't use an interval fund. Because if you invest, kind of going back to the example earlier, let's say $50,000 on behalf of said client, with the expectation that you could take out the $50,000 on need, that $50,000 may take a year to get out. You may get 10 to 15K 3 months later, and then another 10K 3 months later, and this could be really detrimental for the client. These products are generally not marginable, so your client can't even borrow on the product until they get the money back, and so one has to be really careful with that claimed 5% liquidity. Some advisors or a lot of these products allow for more than 5%, but generally speaking, we believe it's traditionally not beneficial for those clients who are staying in to provide more liquidity for investors who want to get out. So generally speaking, it really should match to 5%. And so it's probably the most important area to focus on. And then finally, it just doesn't fit everyone. So we just use an example on the smaller side, a client who might need a lot of liquidity. On the larger side, you have a really large client. The interval fund can make sense. I'm not saying don't ever provide it to a QP client, but you do want to think about, is there something with a more focused and concentrated exposure that I could put this client in because that client can afford it?
Well, Joe, I know that we're going to link a white paper in the notes that accompany this podcast. Can you walk our listeners through what that white paper covers and how it would be useful to them?
Yes, we provide 3 characteristics that are necessary to really scale and grow an advisor to $1 billion and beyond. Our OCIO was purpose-built for RIAs, and we're really focused on emerging advisors. These advisors in the, call it 50 million to 500 million subset, who are fantastic advisors, but may not have the infrastructure or the best practices to scale. We've done it. We know what it takes. We speak about it. And there's a case study in that white paper about alternatives and how to think about alternatives appropriately, because we believe it's a great area. It's growing. So we believe it's really important that every single advisor has a narrative around alternatives and, if comfortable, uses alternatives. But they're risky. and they have to be used appropriately. So that's our takeaway, and I think that's where the white paper can really help, and we'll put it in the liner notes so people have a link to it.
Well, while we're on the subject of takeaways, if there's one key takeaway that you would like to leave our listeners with about why they should add or increase an allocation to interval funds, what would that be?
I actually think advisors are probably allocating too much to interval funds. My gut is that they're probably relying on them way too much. So interval funds are an incredible tool, but it's not the only tool in the subset of tools available for advisors. And while it's simple and some of these other, like a drawdown fund, operationally is way, way more complex, ultimately it could be what's right for the client, and then we have to just go down that rabbit hole and figure out how to be able to provide it. So my key takeaway is that advisors should really think through that cash component that Bob and I spent so much time today discussing, because it's not only about can the client get out, but it's also all these other risks associated with having to hold cash within your portfolio. What is your portfolio manager spending their time doing? Are they spending their time trying to figure out the riddle of how to maintain the cash for the next 5% gate that's about to come, where they know that they're going to have to redeem 5%, or are they focused on really the investment side? And then how does it play out? So I do think the takeaway here, and I was really, by the way, this is probably, I was really excited to do this episode because I think interval funds are this incredible product that, again, my gut is it's probably being overused and creating some risk that may not be so understood.
Great. Well, thank you for listening to episode 2 of Advisor Wars with Bob Huebscher and Joe Halpern. To learn more about Obsidian Asset Management or Joe's work, we'll include a link to his contact information and a link to the firm's website in the notes that accompany this podcast. You can find Advisor Wars on Apple, Spotify, and YouTube, and we'll include a link to connect with us on LinkedIn as well. Stay tuned for our next episode where we will focus on how advisors can implement alternatives into their practice.
Obsidian CIO sponsors the podcast to further education and critical thinking about the factors that affect markets and investing. And the podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement and with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs.